Individual retirement accounts, IRAs, are powerful tools for building retirement savings, but there are two main types: traditional and Roth IRAs. Each offers distinct benefits, tax treatments, and requirements, which can make a significant difference in how you plan for your retirement. While both serve the same goal of helping you save for the future, understanding the key differences between them is crucial to making the best decision based on your financial situation, tax bracket, and retirement goals. In this video, we'll explore the top 10 key differences between traditional and Roth IRAs to help you decide which one is right for you. 1. Tax treatment of contributions. The primary difference between a traditional and a Roth IRA is how they handle contributions. Contributions to a traditional IRA are typically tax-deductible in the year they are made, meaning you can reduce your taxable income for that year. However, with a Roth IRA, contributions are made with after-tax money, meaning you do not receive a tax deduction when you contribute. While this means you won't lower your current taxable income with a Roth IRA, it offers other benefits later on. 2. Tax treatment of withdrawals. When it comes to withdrawing money, the two types of IRAs are quite different. With a traditional IRA, you pay taxes on withdrawals during retirement at your ordinary income tax rate. On the other hand, qualified withdrawals from a Roth IRA are completely tax-free. This is one of the most compelling features of a Roth IRA, as you won't owe taxes on the growth your investments have experienced over the years. 3. Age requirements for withdrawals. Traditional and Roth IRAs have different rules regarding when you can access the funds without penalties. With a traditional IRA, you must wait until you are 59.5 years old to withdraw funds without incurring a 10% early withdrawal penalty. In contrast, Roth IRA contributions can be withdrawn at any time without penalties or taxes because they are made with after-tax money. However, earnings on your Roth IRA contributions must meet the 5-year rule and age requirement of 59.5 to be withdrawn tax-free. 4. Required minimum distributions, RMDs. Traditional IRAs come with a mandatory distribution rule known as required minimum distributions, RMDs. Starting at age 73, for those who turn 73 in 2023 or later, you must begin withdrawing a certain amount from your traditional IRA each year, whether you need the funds or not. Roth IRAs, however, do not require RMDs during the account holder's lifetime, making them a more attractive option for those who want to keep their retirement savings growing for longer or pass them on to heirs. 5. Contribution limits. Both traditional and Roth IRAs share the same annual contribution limits. For 2023, individuals can contribute up to $6,500 per year to an IRA, $7,500 if you're 50 or older. However, your eligibility to contribute to a Roth IRA may be limited based on your income level, whereas traditional IRA contributions are available to everyone regardless of income, though there are income limits for tax-deductible contributions if you or your spouse are covered by a workplace retirement plan. 6. Income limits for contributions. Roth IRAs are subject to income limits, meaning high earners may not be able to contribute directly to a Roth IRA. For 2023, the eligibility to contribute to a Roth IRA begins to phase out for single filers with a modified adjusted gross income (MAGI) of $138,000 and completely phases out at $153,000. For married couples filing jointly, the phase-out range is $218,000 to $228,000. In contrast, traditional IRAs have no income limits for contributions, although tax deductibility may be restricted depending on your income and whether you or your spouse are covered by an employer retirement plan. 7. Early withdrawal penalties. Both traditional and Roth IRAs impose penalties on early withdrawals, but the rules are slightly different. If you withdraw money from a traditional IRA before you turn 59.5, you will typically incur a 10% penalty on the amount withdrawn, in addition to paying income taxes. Roth IRAs allow penalty-free withdrawals of contributions at any time, but if you withdraw earnings before age 59.5 and before the account is 5 years old, you'll face both taxes and a 10% penalty. However, there are some exceptions to the penalty rule for both types of IRAs, such as using the funds for a first-time home purchase or qualified education expenses. 8. Tax benefits for different life stages. One key consideration when choosing between a traditional and a Roth IRA is your current tax bracket versus your expected tax bracket in retirement. If you anticipate being in a higher tax bracket in retirement, a Roth IRA might be more beneficial, as it allows tax-free withdrawals. Conversely, if you expect to be in a lower tax bracket during retirement, a traditional IRA could make more sense, as it allows you to defer taxes and potentially pay a lower tax rate on withdrawals. 9. Impact on estate planning. Roth IRAs offer unique advantages when it comes to estate planning. Since there are no required minimum distributions during your lifetime, your Roth IRA can continue to grow tax-free for your beneficiaries. In addition, your heirs can inherit a Roth IRA and take tax-free withdrawals over their lifetimes, which can be a significant benefit for legacy planning. Traditional IRAs, however, require beneficiaries to begin taking RMDs, and the distributions are taxed as ordinary income, which can result in a substantial tax burden for your heirs. 10. Flexibility in contributions and withdrawals. Roth IRAs offer more flexibility compared to traditional IRAs, primarily due to their tax-free withdrawal feature. You can withdraw your Roth IRA contributions at any time without penalties, making it easier to access your money in case of emergencies. Traditional IRAs, however, are less flexible, as they restrict access to your funds until you reach 59.5 without penalty, and they also require RMDs once you reach 73. This added flexibility makes Roth IRAs an appealing choice for younger savers and those looking for more control over their retirement funds. Choosing between a traditional and a Roth IRA depends on your individual financial goals, current income, and retirement plans. The tax treatment of contributions and withdrawals is a key factor in determining which type of IRA is best for you. If you want to benefit from tax-deferred growth and are okay with paying taxes on withdrawals later in retirement, a traditional IRA might be the right choice. However, if you're looking for tax-free growth and flexibility, a Roth IRA could be a better fit, especially if you anticipate being in a higher tax bracket in retirement. Understanding the differences between these two types of IRAs can help you make an informed decision that aligns with your long-term financial strategy.